Hey everybody, so a very quick update. I'm going to start doing videos on Tuesdays, Thursdays, and Sundays. If I want to do this YouTube thing, I gotta do it right. So I'm going to start waking up a little bit early some days before work to do some of my recordings because I really do want to turn this into something special. So I hope you enjoy the videos and stuff that I'm putting together. And hit that subscribe button. Join me on this investing in YouTube journey. Drop a like and comment down below. Do you own any of these stocks that we're going to be taking a look at today? So I picked out 3 of them that I think are at pretty great prices and that are great long-term compounders. Now, this financial advice, always do your own research before investing. Now, without further ado, SPGI, S&P Global, we got HD in Home Depot, and SBUX in StarBucks. Today is April 22nd. It is Monday. This is going to be coming out tomorrow on the 23rd. So, SPGI, just free cash flow yield 2.61%, dividend yield of 0.88%, the payout ratio just below 44%. All of those are pluses to me. It's on a recent high of, looks like it touched 460, and it's down to 412.56 from this recent sell-off. We want to look at red days as buying opportunities. Revenue's been increasing at a rate of right at 10% over the last 10 years. The free cash flow, 17.7% over the last 10 years. Absolutely beautiful. EPS, it's kind of been a little bit everywhere, but they had to issue out some more shares because they did an acquisition that's messing with this metric, but still yet over the long term up into the right. Take a look at the debt. They have 11.41 billion in debt. They got a little bit over 1.32 billion in cash. Their EBITDA was 5.23 billion. So my general rule of thumb is I don't like companies that have more than 3 times their EBITDA in debt. That's just my personal rule. The dividend, 11.74% increase average over the last 10 years. This last increase was just a penny, but I think they're just trying to get all their finances and stuff in order, so it's nothing to be alarmed about. So as I said, they issued out more shares, but they have slowly but surely been buying back more shares. June 30th, 2022, they had 339.3 million shares. See, they issued out some more, but they've been consistently buying shares back, and as of December, this last December, they're sitting at 315.9 million, so that's about 20 million shares bought back, so pretty good. And of course, that's going to mess with the return on capital employed. But before that, they were doing wonderfully in the 30s and 40s area. The projections for the EPS for this, average for this year's 1071. Next year's 1259. So for EPS, it looks like you are getting right at double-digit growth. If not, that is double-digit. I can't math. It's early. Revenue. Take a look at the revenue. 13.36 billion this year, up to 14.43 billion for next year, and again, I think that's right in line, right at double-digit growth. SPGI has been increasing their dividend for the last 52 years, so a very reliable dividend grower for the long term. Next up, we got Home Depot, just for cash flow yield of 5.29%. We got dividend yield 2.68%, payout ratio 56%. Again, all of those are check marks for me. This was off a recent high right at $400, and it just fell down to $335, so it might open the door for a buying opportunity if you've been looking to jump into Home Depot. Over the last 10 years, revenue has been increasing at a rate of 6.84%. Free cash flow has been increasing at a rate of 11.14%. That is awesome. EPS, 14.92% growth. Their debt right at 30 billion. They have a little bit over 3.76 billion in cash, and their EBITDA was 24.94 billion. So again, my personal what I look at, that's not an issue. The dividend, 16.95% increases over the last 10 years, even though here the last little bit they've been doing a little bit slower. You're still looking at 7 to 8%, which is long-term inflation beating, and you want that from your companies. You want inflation beating dividend growth, because if you're not doing that, you're losing money in the long run. Get your money's worth. Shares outstanding, this is where they shine. Over the last 10 years, buying back shares at a rate of 3.52%. That is very aggressive, and I love to see that. And all these are above 2%. And as you can see, it is just going down, 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 which is exactly what we want to see. From 2015, they were at 1.35 billion. To 2014, they are right at $1 billion. So they have bought back a ton of shares, and they continue doing that, and I love it. Return on capital employed has pretty much been 36 or higher since 2015. It fluctuates a little bit here and there, but it's very consistently high. EPS average 15.35 for 2025, and it looks like 16.44 for 2026. So that is right at double digit, I believe. Not quite, but still some nice continued growth. Revenue 1.54.3 billion and up to 158.36 billion. So I think that some of these estimates are going to go up, especially over the next 2 years, because when interest rates start getting cut, people are going to start building homes and doing home improvements and stuff again. And I think they're going to get revised up. Again, that's just my personal view on it. I'm not saying go out and buy it. Just letting you know my personal opinion. Home Depot's been increasing their dividend for the last 15 years. So again, some nice, solid, consistent growth out of them. And next up, we got Starbucks. I love Starbucks below 90. I would just go ahead and admit it. I'm a fan. I'm a big fan of this company long term. Just free cash flow yield 4.09%. We got a dividend yield 2.6%. Payout ratio 58.8%. Revenue's been increasing at a rate of 9.22% over the last 10 years. Very nice and up and to the right. Free cash flow 7.66% over the last 10 years. Again, pretty up and to the right. EPS, you can see, very nice up and to the right trend. Debt, they have 12.27 billion. They have right at 4 billion in cash, and their EBITDA is 7.33 billion. So again, things look good in that department. The dividend over the last 10 years been increasing an average of 15.93%, but here recently about 7.5% is what they've been increasing it by, which is still fine by me. It's just very consistent long-term inflation beating growth. Share buybacks, we'll take a look at the quarterly here. As you can see here, they just do a nice little job at nibbling here and there at some shares. Again, you want your company buying back shares over the long term. Over the last 10 years at a rate of 3.77%. So again, very nice, love to see that. And the return on capital employed, they had the 2020 dip, but since 2021 we're sitting at 20.96, 2022 is 24.53, and 2023 is 29.21. So it's very rapid growing return on capital employed, which you love to see. EPS average 4.06 for 2024 up to 4.75 in 2025, and the revenue 38.83 up to 42.63 from 2024 to 2025. So I think that's right at double-digit revenue growth. It's right in line with what they've been doing. And the dividend has been increasing over the last 14 years. So again, a very nice compounder. That's the 3 stocks I'm going to be taking a look at. Again, hope you enjoy that. This will be coming out on Tuesday, the 23rd. I am recording it on the 22nd just in case the prices change a bunch. But anyways, like the video, hit the subscribe button, join me for more, and until next time, take care. See you.